Hello, all. I want to talk about money market funds. And if you remember, I imagine that you have $1,000 and it is sitting in your checking account, and you have had it, for example, for 1 year, and only you check it after 1 year, you see two pennies or added, five pennies or added to your $1,000, which means it hasn't grown at all. You could put this money in your saving account. And in that case, maybe after 1 year, it would have been $1,001, maybe $2. That means you earned $1 interest on it, and then you are not a happy camper. You prefer that you could put it in somewhere that could give you more interest. You could talk to your bank and you could buy CD, certificate of deposit, which means the bank enters into a contract with you, and contract that says you are not supposed to take your money out for a period of 1 year. You should leave it in the bank, and in that case, the bank might give you, let's say, 4%. Here, you are getting 4%, but at the same time, for 1 year, you cannot touch the money. If you do, you lose that 4%. Yeah, that means that instead of after 1 year having $1,040, you take your money out, then, that means that you have lost that 40,000. You won't lose your $1,000. Now, the question is that how you can make more money on your $1,000. One option is to go to brokerage houses, which are exactly like banks. Even they have their own banks as well. As I said, like Vanguard, like Schwab, Charles Schwab. And you open an account with them and you put your money in money market funds. When you put $1,000 in money market funds, these are what you will see. They are safe and stable. Money market funds are considered relatively safe investment because they are putting your money in highly liquid. The meaning is that means anytime you want, you can sell it. Your house is not liquid because if you decide to sell it, it takes months, years. Yeah. But that money market, at any time you can sell it. And when the brokerages like Schwab, like Vanguard get your money, what they do, they buy treasury bills. These treasury bills are extremely safe because they are backed by the US government. We know that US government is very powerful. It's not going to go out of money easily. Why? Because anytime the government runs low in cash, they can go and raise the taxes. Therefore, it is the safest investment that you can have. Treasury bills, commercial papers. That means when they get your money, the brokerage firms, they'll give a little bit maybe to the government, federal government, commercial papers. Let's say Walmart needs, let's say, $1 billion. It goes to Vanguard and say, can we borrow, $1 billion for 2 months, 6 months? Vanguard says, okay, give it supposed to Walmart, or not just to Walmart, it distributes it, some to Walmart, some to Exxon, some to Apple, some to Microsoft. Therefore, your money is not being invested in risky, projects. Therefore, nothing you be worried about that. All you will do, you will give your money to the brokerage house, and that brokerage house, like Charles Schwab, gives you 5%. Do you see? And your money is liquid, which means highly liquid. Anytime you want, you can withdraw your money. Unlike CD that you have to leave it for 1 year. Returns for these money market funds are modest. They don't go up as much as stocks go up or bond go up. Their return, bonds might give you 6% return. Stocks on average might give you 12% return, but money market funds might give you 5%. And of course, if the interest rates drop, money market funds give you less. And NAV means net asset value. Usually, you buy shares of $1. When we say share, don't think about them as shares of stocks. Think about if you have the $1,000. Your $1,000 is capable of buying 1,000 of these $1 per share. These shares, as I said, They don't go usually up and down. They just stay $1 at all times. However, interest, is added to this, this $1. That means every $1 after 1 year becomes $1.05. Therefore, because you have $1,000, your $1,000 after 1 year becomes $1,050. You see, these are very solid, investment for those people who don't want to buy stocks. Some people say, oh, stocks are risky. They say they don't understand bonds and they are not happy with their money in the bank. This is the solution: money market funds. And primarily they invest in US government securities. Government securities are very safe, are the safest, including treasury bills, repurchase agreement by the government. There are different types of money markets. Some that are investing in government funds, some are investing in corporate, short-term corporate, lending, like commercial paper. Means that suppose if Walmart needs some money for 2 months, 3 months, they go and to Charles Schwab, they go to Vanguard and say, can we borrow some money? I say, okay, they give it to them. Therefore, your money is lent out, is given to companies by the brokerage firm. And therefore, those companies, the possibility of, suddenly 10 very important, 50 very important companies go bankrupt is almost impossible. That Walmart, Costco, Apple, Microsoft, all of them go bankrupt. Therefore, your money is overall in a very safe place. Or they might give your money to local government. Imagine that the state of West Virginia needs to, build some highways and they need to borrow some money. Therefore, they go and to brokerage firms and they say they borrow some money. And if brokerage firms give money to the state of West Virginia, usually these brokerage firms, when they get interest back from them, they don't pay any interest because they are being invested in municipal bonds. They have, and these money market funds, fortunately, are being regulated by Securities and Exchange Commission, SEC. This is an organization that is always there to make sure that these public companies, these organizations are not cheating. They are like IRS, but they are checking, companies, they are checking the stocks of the companies to make sure everything is legal, to make sure they are compliant with, rules and regulations. Therefore, we want you to be aware. We know about these things. Here talks about risks, but these risks are extremely, extremely low. Credit risk or liquidity risk. We said that they are always liquid. The possibility of them running into the is very, very extremely low. Therefore, my recommendation is, if you want to know about them, think about them. If you have money in the bank, my recommendation is think about this as another way of investment. And as you all know, this is called personal finance, this course. It is all about learning about these things to see what we can do to make our money grow, to become, a more successful investor.